Okay, we are now on our module 4, interim financial reporting and development stage entities. No? And our learning objectives are define what is interim financial report. We have to state the scope and applicability of PS34. Describe the income and expense recognition principles followed in the interim financial reporting. How income tax expense is computed in the interim financial statement. Identify development entities and reporting requirements for a development stage entities. Topics are interim financial reporting and development stage entities. No? And first we have the definitions of term. What do you mean by interim reportings? It pertains to the preparation and presentations of interim financial reports of an interim period. An interim period, a financial reporting period shorter than a full financial year or 1 year or 12 months. Interim financial report means a financial report containing either a complete set of financial statement as per PS1 or a set of condensed financial statement PS34 for an interim period. Scope: PS34 does not require entities to provide interim financial reports. PS34 applies if an entity is required by government, securities regulators, stock exchanges, accountancy bodies. The entity elects or chooses to publish an interim report in accordance with this PFRS. PS34 encourages public traded entities to provide at least semi-annual interim financial report and publish them not later than 60 days after the end of the interim report. The content of interim financial reports are: an entity presenting an interim financial report has option of complying either PS1 or the complete set of financial statement, or PS34, the condensed set of financial statement. The complete set of financial statement as per PS1 is that statement of financial position, statement of profit and other comprehensive income, statement of changes in equity, statement of cash flows, notes comprising a summary of significant accounting policies and other explanatory information. And we have the comparative information with respect to preceding period and statement of financial position as at the beginning of the preceding period in cases of retrospective application, retrospective restatement, or reclassification adjustment. The minimum content of an interim financial report under PS34 are condensed statement of financial position, the statement of profit and loss. We got the condensed single statement and the condensed separate income statement and condensed statement of comprehensive income, the condensed statement of changes in equity, the condensed statement of cash flows, and selected explanatory notes. The term condensed means an entity needs only to provide the minimum information required in PS34. However, an entity is not prohibited for publishing a complete set of financial statement in accordance with PS1 in its interim financial report. Furthermore, an entity is not also prohibited from including in its condensed interim financial statement information that is more than the minimum lines items as selected explanatory notes on all set up under PS34. Additional concepts are relevance over reliability. In the interest of timeliness and cost consideration, This information may be provided at interim dates. Materiality and estimates. An entity may rely on estimate to a greater extent when preparing interim financial report. Notes disclosure. Only selected explanatory notes are provided in interim reports to avoid repetitions. So, period in which interim financial statements are presented are semi-annual interim financial reporting. So, the interim financial report as of, we have the current and then comparative with that of 2020. And then statement of profit and losses on other comprehensive income, you may have 6 months ending, and then statement of changes in equity for 6 months ending, and also with statement with cash flows. Business is highly seasonal. If an entity's business is highly seasonal, PS 34 encourages disclosure of financial information for the latest 12 months and comparative information for the prior 12 months period, in addition to the interim period financial statement. Recognition and measurement. Gains and losses arising in interim period are recognized immediately and are not deferred. Inventory write-downs, reversal, asset impairment, losses and reversal, discontinued operation, and fair value changes on assets measured at fair value. Costs and expenses that benefit in the entire year or are earned over the year are spread out over the interim period. Depreciation, amortization, property taxes, insurance expense, interest expense, 13-month pay, and other year-end bonuses. A discretionary income is recognized immediately in the period the income is earned, or a dividend income. Income tax in the interim period is computed using the best estimates of weighted average annual income tax rate expected for the full financial year. The IFRS standard do not require companies to prepare interim financial statement, but many companies do so either by choice or to comply with laws, regulations, contractual requirements. Both IFRS standard and US GAAP prescribe specific recognition and measurement requirements for determining interim period balances. The minimum content of interim financial statement and presentations of comparatives. There are a number of differences between the standard could affect reporting for dual filers or companies considering the conversion. Here are the summaries of 10 GAAP differences related to interim reporting. The PICS 34, a company is not required to prepare interim financial statement in order for its annual financial statement to comply with IFRS standards. However, local laws and regulations may require company to prepare interim financial statement and also specify the frequency, either quarterly or half-yearly. The companies that prepare interim financial statement may elect to present them in a condensed format. In this case, the simplified presentation disclosure requirement ICS 34 apply. The condensed interim financial statement include at a minimum. So, these are the summaries. And condensed interim financial statement are meant to be read in the context of the last annual financial statement and generally focus on changes since the last annual reporting date. How is ICS different from ASCS 270? Similar to its GAAP equivalent, ASC ASC 270 at IAS 34 not only deals with presentation and disclosure but also addresses recognition and measurement of the interim period. The two standards are built in two different premises other than income tax. Under IFRS standard, items are recognized and measured as if in the interim period were a discrete standalone period. Under US GAAP, its interim period is viewed as an integral part of the annual period to which it relates. This gives rise to multiple differences in practice. To summarize, first, we have recognition and measurement. Costs are mostly recognized as incurred under ECS 34. US GAAP may allow smoothing. Under IFRS standard, costs are may be anticipated or deferred at the interim reporting date only if it would only be appropriate to anticipate or defer the type of costs at the annual reporting date. The US GAAP permits certain costs to be allocated to interim period based on estimate of time expired, benefit received, other activities associated with the interim period, such as recognizing a proportionate amount of year-end bonuses based on an estimate of annual amount. Similarly, GAAP may support accruing advertising expense based on annual budgeted spend or deferring advertising expenses beyond the interim period in which the expenditure is made. According to US GAAP, specific interim recognition rules for property taxes that may not align with the accounting for levies under PFRS standard. Cost variances on inventory must be recognized in ECS 34 and US GAAP allows deferral. So under ECS 34, losses resulting from cost variances on inventory must be recognized in the interim period in which they arise, even if the company expects to recover them later in the fiscal year. Under the US GAAP, such losses may be deferred because the interim financial statements are considered an integral part of the annual report. Interim remeasurement of entire benefit comprises preparing interim financial statements are sometimes able to obtain a reliable measurement of the net defined benefit liability using extrapolation by adjusting the opening balance of the net defined benefit liability for items of income and expense such as current service costs, net interest on net defined benefit liability, contribution to plan, and other changes. Under IFRS standard, net defined benefit liability remeasurements are required when there is a settlement, curtailment of a plan or plan amendment. In addition, for interim reporting, significant market fluctuations are considered, and that process may trigger the need for an updated actuarial valuation. The potential materiality of the measurement should be assessed to determine whether an updated valuation is necessary, determine their effect on the interim financial statement. The recent market fluctuation caused by COVID-19 may trigger such measurement. Under US GAAP, net defined benefit liability measurements are required when there is a statement curtailment of plan like IF standard. However, under US GAAP, significant market fluctuation do not trigger measurement consideration unless a company has an established policy for such measurement, resulting in the potential differences in IF standard. For income taxes, accounting for change of tax rate enacted in interim period differs. Under IFRS standard, companies account for changes in tax laws enacted or is substantially enacted in an interim period either by recognizing the change in the interim period in which it occurs or by spreading the effect in the change in the tax rate over the remainder of the annual reporting period through adjusting the estimated annual effective tax rate. U.S. GAAP required changes in tax rate enacted in an interim report to be recognized immediately in the interim enactment. The determination of effective tax rates differs. Under IFRS standard, companies with exposure to multiple tax jurisdictions with different tax income categories are required to apply separate effective rates for each jurisdiction and income category to the extent practicable. A weighted average accounting for charges and deferred assets, deferred recovery. Under IFRS, if management estimate to the recoverability or of unused tax losses changes during an interim period, we believe it is acceptable for changes to be reflected in calculating the expected annual effective rate and apportion between interim periods. Under the U.S. GAAP, a change in estimates of the beginning of the year deferred tax asset valuation allowances is recognized in the interim period in which the change occurred, when its results from a change in judgment are realizability in future years. Changes in valuation allowance arising from changes in tax laws also are recognized in the interim period in which the change occur. Other changes in valuation allowance are generally included in the estimated annual effective tax rate. The above differences may be particularly impactful this year due to CARES Act, which provide various forms of retrospective income tax relief and other easier recovery of net operating tax losses. So, we got the contra-virus accounting and reporting impact on CARES Act. Other GAAP differences in the accounting for income tax may arise between of the general differences between IFRS standard and US GAAP on this topic. So, you may see this, no? Forms and content of the condensed interim financial statement differs. Under IFRS standard, condensed interim financial statement include a minimum each of the heading subtotal that were included in the most recent annual financial report. There is no such requirement under US GAAP. In addition, ICS 24 requires presentation of a condensed statement of changes in equity. This statement can be omitted under US GAAP although significant changes in equity are disclosed. Revenue disclosure differ. Under IFRS, the company is only required to disclose its interim financial statement, disaggregated revenue, and explain the relations to revenue for its reportable segments. Other annual disclosure for revenue from contracts with customers typically are not required. So, in contrast, under the US GAAP, interim revenue disclosures are the same as annual disclosure for public companies. Private companies are permitted to provide limited revenue disclosure in interim financial statement under U.S. GAAP. Calculation and presentation of basic and diluted earnings per share differ. Public companies are required to present both basic and diluted earnings per share for net income in interim financial statement under both IFRS and US GAAP. Although not explicitly required by ECS 34, companies would generally present earnings per share for continuing operation in addition to EPS or total operation as it required under US GAAP. When there are market fluctuation or one-time events in an interim period, companies may be inclined to provide interim EPS information based on alternative measure. Under IFRS standard, EPS information based on alternative measures of earnings may be disclosed and explained in the notes to the financial statement. However, such EPS presentation is not permitted in the statement of profit and loss and OCI under IF standard. Under US GAAP, entities may choose to present basic and diluted other per share amount in the notes of financial statement, but cash flow per share is not permitted. Additionally, SEC regulations restrict the use of alternative measures of earnings that are considered non-GAAP measures in filing SEC registrants. Under IFRS and US GAAP, if a contract can be settled in either cash or share, then it is a potential common share. Under IF standard, however, if settlement in cash or share is at the company's option, then the company presumes settlement in common share. Under US GAAP, the company generally presumes settlement in share, although existing practice or stated policy of settling in cash may provide a reasonable basis to overcome this presumption. Under US GAAP, the cash settlement assessment is performed at each reporting period and therefore its interim period. Presentation of segment information may differ. Companies reporting segment information in their annual financial statement to do so in interim financial statement under IFRS standard and US GAAP. ECS 34 requires companies to disclose revenue from external customer, inter-segments revenue, total assets and total liabilities for each reportable segments if the information is regularly provided to the chief operating decision maker. US GAAP requires companies to disclose revenue from external customer, inter-segment revenue, and total asset, even if such a measure is not regularly provided to the CODM. US GAAP does not require companies to disclose total asset. Irrespective of GAAP, interim reporting often presents inherent challenges for companies due to uneven revenues and costs in the financial year and the higher degree of estimation involved. Additionally, though reporters need to stay vigilant about the difference in approach to inter-reporting between IFRS standard and US GAAP. Additionally, recognition, measurements, and presentation differences exist from those already tracked for annual financial statement. In certain areas, interim reporting under IFRS standard may appear to have stricter requirements than US GAAP, but be better aligned to annual close procedure. Conversely, Interim reporting under US GAAP may offer better alignment to budget and management reporting procedure. Companies may take advantage of accounting policy election available under those framework to achieve better consistency and minimize such differences to the extent possible. So you may read IF compared with the US GAAP. Accounting Standard Update 2014-10, Development State Entities, the elimination of certain financial reporting requirements including amendments of variable interest entities guidance to topic 803 consolidation. The background information and basis for conclusion, the following summarizes the board consideration in reaching the conclusion of this update. It includes reason for accepting certain approaches and rejecting others. Individual board members give greater weight to some factors than to others. Amendments of this update remove the term development stage entity and eliminate the incremental presentation and disclosure requirements for a development stage entities. Reduces costs, simplify accounting guidance, increase the relevance of information presented to the financial statement users without reducing decision useful information by doing the following. Eliminating the requirements for development stage entity to present inception to date information in the statement of income, cash flow, and shareholders' equity. The amendments topic to clarify the risk uncertainty disclosure requirements applies to entities that have not commenced principal operation. Eliminating the inception related to the sufficiency of equity at risk for development stage entity from the guidance of variable interest entities to increase consistency in application of consolidation guide across all entities, and then removing the definitions of development stage entities from the master glossary. So background, the Private Company Council added a project on its agenda to determine whether the inception to date presentation requirements for development stage entities codified in topic 19 should be amended or eliminated. The PCC initially requested that the staff determine whether the cost to prepare to provide inception information required by the topic was supported by benefit to users of private companies' financial statement. Staff research of this issue found that the issue also relevant for public companies. As a result, added project to its agenda on the meeting. Most of the guidance in the topic was provided. So, accounting and reporting for development stage enterprise and has not been amended substantially since statement issuance in June 1975. Statement 7 became effective for fiscal year beginning after January 1, 1976. The required that the development stage entities also apply US GAAP applicable for established operating entities. Thus, development stage entities were required to present the same basic financial statements and follow the same recognition and measurement requirement for revenues, startup costs, and other similar incurred costs as to established operating entities. Topic 9.1.4 provides general presentation and disclosure requirements for an entity on development stage. The guidance required a development stage entity to present inception information in the statement of income, cash flow, and shareholders, label the financial statement as those of a development stage entity, disclose description of development stage activities in which the entity is engaged, disclose the first year in which the entity is no longer a development stage entity that in prior years it has been in development stage. Thus, incremental requirement resulted in financial statement that were potentially more costly to prepare and audit than those established in operating entities. A discussion about the amendments with investors indicated that inception to date information provides little information really relevant to the investment consideration. In addition, the accumulated loss information within the inception information often includes costs related to more than one product that is under development stage or product or development strategies that may have been abandoned. Therefore, they are no longer relevant. Instead, investors stated that they considered the adequacy of current and future cash flows, the feasibility of the business activities under development, and other non-financial market indicators or conditions that may affect an overall entity's success making their investment decision. So, in November 2013, the board issued proposed accounting standard update development stage entities, elimination of certain financial requirement, which proposed superseding topic 91 along with a proposed conforming amendment to eliminated product. The comment period ended December 2013. The board received 24 comments letter, mainly accounting for and state CPA society. Major of the respondents agreed with the guidance in the proposed update, long-lived development stage BCA. Some stakeholders stated that the guidance for topic 915 has become onerous for some development stage entities because the nature of some of those entities had changed since the issuance of Statement 7. A review of rationally for Statement 7 indicated that Beactg was aware that some entities may remain in the development stage of several years. However, in its deliberation, the board at that time did not appear to contemplate the development stage entities that would be long-lived or perpetual in nature. Currently, development stage entities often remain in the development stage for many years before the preparation of U.S. GAAP. Financial statement may be required and before engaging in an accounting firm to audit those statements. As a result, some entities incurred significant audit costs related to this effort to compile and present inception cumulative information in preparing their first financial statement under U.S. GAAP. In addition, a development stage entities often issue complex equity instrument, warrant, preferred stock, unit terms or dilution, and subsequent issuance that can require numerous pages of disclosure when presenting equity transaction from inception to date for which reporting period. Stakeholders stated as development stage entities mature or seek to become public companies, they also may change auditors. New auditors may perform detailed audit procedures related to inception to date information, which may result to insignificant increased cost. Additionally, these are entities that identify themselves as development stage that do not plan to produce or market any product under development. Instead, the entity's primary purpose is to perform research and development on many products and to sell potential successful product development to manufacturing and marketing-driven firms. Many of those entities never progress beyond the development stage. Examples of these are found in industries such as pharmaceutical, biotechnology, or software development. Since the issuance of the Statement 7 in 1975, the way users obtain financial information, particularly for public companies, has changed dramatically and has become more easier for individuals interested in a specific type of information to gather and aggregate that information in numerous ways. In particular, public filings can be search and aggregate to accommodate users' needs. If any, the inception to date information through public access to historical filings by internet, research tools, electronic data gatherings, analysis, retrieval system, web-based data service provider, and extensible business reporting language. Therefore, similar inception information can be gathered from the publicly available sources without that information being specifically required to be accumulated and presented in current period financial statement. So, discussions with users on financial statements of non-public entities indicate that they are also obtained information from to meet the specific information need not meet by general purpose financial statement. The board decided to eliminate the requirement for development states to present inception date information in the statement of income, cash flow, shareholders' equity on the basis of stakeholder feedback, which included responded to exposure draft. Respondent indicated that the information is not useful to users of financial statement of development states entities and is costly for preparers to provide. The board stated that the original purpose of this development states entity distinction sets out in Statement 7 is no longer relevant. Additionally, for public companies, the inception date information is publicly available through various data resource tools. For private companies, and this information may be available via direct users access to management. Disclosure requirements. Discussions with the investor indicated that the remaining requirements discussed in Beactg 5 were not decision useful. Investor indicated that they do not find the description of development states entities useful because they do not distinguish those types of entities in that matter. Disclosure about the activities in which the entity is engaged usually are evident in the entity's management decision and analysis as part of documents given to potential investor and readers to support investment on funding requirement. Therefore, the remaining disclosure are not appeared to provide decision useful information. Several stakeholders suggested that eliminating the remaining disclosure and clarifying the risk and uncertainty disclosure requirements shall apply to entities that had not commenced planned principal operation. The clarification would ensure that the information in this topic about entities' current activities is presented consistently in one location in an entity financial statement and streamlined disclosure requirement. Respondent to this draft agreed that all other remaining disclosure requires should be eliminated. Respondents and individuals contacted through outreach efforts suggested that disclosure would be more useful if they included information about what the intent operation of the entity, the activities of which the entity is currently engaged, and when management plans to begin operation. So, the board decided that the suggested alternative disclosure are more prescriptive than the broader nature of disclosure guidance in this topic. Additionally, the board decided that the suggested disclosure in item C relates for forward-looking information that may be difficult to apply for some entities that have not commenced planned principal operation. Even though development stage entities are within this scope, the accounting standard codification uses the term operation rather than the term activities. Therefore, some entities that have not commenced planned principal operation may not consider disclosure requirements. The board decided to classify all entities, including those that have not commenced planned principal operation, The board noted that Issue 9916 addresses the specific agreement that occurred the development state entities but does not comprehensively serve as a substitute for consolidation analysis. Additionally, the Naturally of Statement 7 stated that the board at time was aware that entities may remain in the development stage for several years. However, in its deliberation of Statement 7, the board did not appear to contemplate development state entities that would be long-lived or perpetual in nature. Additionally, no conceptual basis exists to support different consolidation guidelines for a development stage entities. Accordingly, the board decided at this time to eliminate the guidance of variable interest entities for development stage and require all entities to apply the same guidelines for consolidation decision. Few respondents indicated that they considered paragraph by analogy to access the identification of the primary beneficiary in non-development stage multi-phase entities in assessing who has power over the activities that most significantly affect the variable interest entities. An economic performance, those respondents access only to current phase of the entity's activities when there are multiple phases in differing activities and significant uncertainties exist. That assessment could result in designation of different 29 primary beneficiaries, beneficiaries from one phase to another. Further, outreach indicated apparent similarities between accounting firms when determining the primary beneficiary in the case of in which there were multiple phases with uncertainties associated with getting to the next phase of activities. However, there appeared to be the difference in how some of those response arrive at consolidation. While some of those responded reference, others appeared to be performing a more general list of significant activities and asking whether there are uncertainties that should be considered in assessing the likelihood of the multi-phase entity searching subsequent phases of activities and determining the appropriate primary beneficiary. One of those respondents suggested that if this paragraph was eliminated, it would be useful if the board provided an example that demonstrates how to identify the primary beneficiary when analyzing a variable interest entity that has multiple distinct phases. Some board members consider application by analogy and determine what primary beneficiary beyond the explicit of exception provided. Thus, they may see reason that the elimination of an unrelated provision should affect the primary beneficiary determination if performed properly under existing guidelines. Furthermore, board considered that suggested to be beyond the scope of this project. The definitions of development stage entity, the board decided to remove the definition of this from the Master Glossary of Standard Codification on the basis of the effect of its decision to eliminate any special reporting requirement by development stage entities. The definitions will be removed currently with elimination of this paragraph. The board decided if an entity is reporting the inception information or other remaining disclosure, the amendments in this update should be applied retrospectively except for clarification on topic 275, which shall be applied prospectively. For public business entity, the changes are effective for annual reporting period beginning December 2014. An interim reporting periods therein for other entities, the changes are effective for annual reporting period beginning December 2014. And an interim reporting period beginning after December 15 entities are allowed to apply such guidance only early for any annual reporting periods or interim period for which the entity's financial statement have not been issued or made available for issuance. Upon adoption, entities will be longer present a disclosure. The board also decided that if the entity's consolidation decision changes because the board eliminated the exception of development stage entities, the amendments in this update should be applied retrospectively. Transition guidelines for the retrospective application is the same transition guidelines that the PAS B provided. Statement 167 Amendment for FASB Interpretation Number 46. If an entity has to consolidate a variable interest entity as a result of change in accounting, the board decided to provide additional time for entities to apply the guidance of it because they may be first time that the entities will apply the variable interest entity consolidation guidelines, and they may need to perform the variable interest analysis, aggregate, draft new variable interest disclosure, address issues that may arise if the consolidation decision changes. Benefit and cost. The objective financial reporting is to provide information that is useful to present and potential investors, creditors, donors, and other capital market participants in making rational investment, credit, and similar resources allocation decision. However, the benefit of providing information for that purpose should justify the related costs. Present and potential investor, creditor, donor, and other users of financial information benefit from improvement in financial reporting, while the cost to implement new guidance are borne primarily by present investor. The board assessment of the cost and benefit of issuing new guidance is unavoidably more qualitative than quantitative because there is no method to objectively measure the cost to implement the new guidance or to quantify the value of improvement information in financial statement. Okay, we are through with our module 5. Thank you very much. And the next module will be cost basis, accrual basis of accounting, financial reporting in hyperinflationary economics. So you may do your activities in every module passed within the given period, and always stay safe. Thank you.